So this question which we had done previously, question number 5, has repeated in the examination. Okay, as far as I think, it must be the same, like just changing the number. It's a procedural question, correct? But when this question came as a procedural question, you understand in the study material that there were two methods: YTD method to solve the problem, another is cumulative adjustment. But they have followed the cumulative adjustment method. Contract had a fees of 22 lakhs and cost was 20. So 2 must be your profit. Over a period, cost to cost input method has to be used. They have told you incentive also 2.2, 5.5. The entity's extensive experience, they said that there is a 10%, 25% chances. So based on the analysis is the same story. So you will go for the 10%. So if you go for 10%, you would have included 2,20,000. Now later you change that assessment, and after, when, therefore entity revise the estimate when? In the year 4, same, exactly like the study material question. No change at all. So they have given you the cost. Analyze the impact of changes in the variable consideration when cost incurred is as follows. See students, this is the analyze the impact of changes in the variable consideration. What do you understand by this sentence? How many questions are there? See, the questions are, this is one question, this is one question. So many things, other things are going to come. What do you mean by analyze the impact of changes in the variable consideration? What they are asking? Sorry? What in our language, in one word, if you want to tell you, what is that? They are asking you cumulative catch-up adjustment. Impact of change in the variable consideration. That means because of the change in the variable consideration, how much cumulatively you are going to adjust. Then second, they said, see, all these things were not there in the study material, but they are solved in the study material. They asked you to calculate the revenue, operating profit and percentage of margin. See, this is one, cumulative catch-up adjustment. Calculate yearly revenue, second, operating profit, third, margin. That means that in this one question, there were actually 4 sub questions are sitting. Now for simplification purpose, it is not simplification, for difficulty purpose. In fact, simplification is what YTD method is the most simple one. So for difficulty purpose, calculate revenue for the year independently based on the cost incurred during the year only. That means they are asking you follow specifically the second method, or the whatever you can call first method, where cumulative catch-up adjustment need to be done. See, when they tell you like this very specifically, yes, you cannot deviate and say calculate YTD method. If this was not there, yes, you could have done YTD method. Okay, let us compare the answer. See, the first, I will take the fixed cost here, my cost to complete. So I will take my proportion of, this is my actual cost incurred here. Where is this actual cost? Estimated variable cost. Sorry, variable consideration. This is what you have included in the first 3 years. Now, fixed revenue, how did you get? This is your actual cost incurred. Actual cost to total cost gives you percentage of completion. That into fixed consideration, that into variable consideration. You got the fixed consideration, variable consideration. You got the total sales revenue recognition, revenue, minus cost, you get the profit, and find out the cost, profit divided by sales, percentage of the margin. Did you get 17.36%? No, what happened? Any mistakes? No, not solved. Okay, others? Okay, how much? Did you get 25,200 margin? Sorry? Revenue, okay. This 41 lakh 45,200. Okay, see, first year, it doesn't make any difference which method you follow. Both methods are same. But when it comes to the second year, your difference is going to happen here, because second year, you have to take 3,70,000 by 20. That means only how much completed only during second year, not YTD. If you want to looking YTD, then you have to take total cost divided by total estimated cost. Now problem, I'll tell you one more thing. What if my estimated cost also going to change? That's why YTD is always the best one, because it will incorporate every adjustments. So like this, second year you will take only the percentage, calculate the fixed and revenue total and minus the cost, like this you will proceed. When it comes to the fourth year, your fourth year variable is going to change now. Because of this, and then percentage of completion you will calculate same 5.7 divided by 20. You take both the things and see how much increase happened. 5.5 minus 2.2, 3.3 is the increase. If you knew on day one only, all these first 3 years you would have charged some portion of 3.3, which is up to 3 years earlier how much is complete. That adjustment is this 2,16,150. Did you get this 2,16,150? No, you should get this 2,16,150. Yeah, we can do it, no? Okay, just do it one thing. Just tell me the number. See, how much is the total cost you have incurred? 1.2 plus 3.7 plus 8.2. How much it comes to? 13.5 divided by 20 estimated cost. How much? 65.5 into how much additional amount you should have recognized? 3.3. 3.3, no, 5,50,000. If you knew on day one only, 2,20,000, so by default it is included. 2,20,000 in this 5,50,000 is by default included. How much extra you change your estimation today? So how much it comes to? 3.3 into 65.5%? 2.16. Understood, no? It's a simple way. If you open the study material and all, in a different way they have done that adjustment. Doesn't matter. You should be in a position to understand all the ways, whatever they do, whichever format. See, that is the clarity in thinking. Irrespective of whatever they do, you know this is what it is. No confusions. Clear? Now, let me take my method, another method, YTD. In YTD method, we would have calculated the percentage of completion by taking cumulative cost. What they did, they took the cost for the period. Why? Because the question specifically tells that. Then I straight away go take this total transaction price, take this percentage, multiply YTD revenue first year, so you will get the same. But the second year onwards, I will take the YTD revenue minus the previous revenue for this cost. If you see nowhere, 2,16,000 is going to come because it is already adjusted in this particular value. If you see 9,99,900, if I go to the ICM method, 9,99,900. But in YTD, this adjustment is not going to happen. It is already incorporated. Then I have also got the profits, the margins. Okay, you can practice. You understood both the ways, right? Yes. Now cumulative. Okay, if at all, the question is very silent, which method to follow. Institute also given the note, no? See here they said in practice people do follow YTD method. If the question is silent, you can follow this method, which is much simpler, and do one cumulative adjustment only for the sake of note, which is 3,30,000 extra consideration and 65.5% is complete. Are you clear? Yes. So we started in days 115. What is the first thing we started with? The contract. How many conditions? 5 conditions we have to verify. Second, once you identify the contract, you have to identify performance obligation. Performance obligation is nothing but a promise only. So there can be 2 types of promises. Promise for distinct, promise for series of distinct. What you need to do is simple. In one contract, irrespective, it can be a combination of distinct and series of distinct also. I can give you monthly IT support At the same time, in that contract only, I will say that I will replace, I will give you more printer and this thing also. I will sell you printer also, along with the IT support. One is series of distinct. One is distinct, like maintenance of the inverter and inverter sale. Okay. So now what I need to do is I have to figure out, is there a single performance obligation or it is having a multiple performance obligation. Now once you decide how many performance obligations are there, for this you have to have a product level test and a contract level test. For contract level, you have got three conditions: integration. Okay, product level, you have got two conditions: it should be ready to use, or you should be able to use it with readily available resources. Either you should be able to use it readily, or whatever resources you have, you should be able to use. It should not happen that you cannot use that on a standalone basis. Like you buy a machine, a special machine, but you don't know how to install it. You have to call that guy only. So installation is not a special service there, distinct service, because it cannot be independently used other than the product. Similarly, integration, customization, interdependency. Which interdependency? Two-way interdependency. Then series of distinct, you have got the same pattern of transfer, and what you have? Same method to measure the progress. Is a substantially what you transfer is substantially same and same pattern of transfer. In series of distinct, what you transfer is substantially same and you have got the same pattern of transfer. Same pattern of transfer means over the period of time and same method measure of the progress billing. Yes, with this we are done. Third, we will decide the transaction price. First we will see, is there a fixed consideration? No headache, no question. In every question is the most simplest thing. So we didn't discuss also. Second question comes, variable consideration is there. If it is there, you have to constrain it. Constrain means just write one theory that we should include only that much, which we assume that it should not get reversed. But how do you estimate? This is expected value method, most likely method. See, mind mapping. Easy, no? So expected value and the most likely method. But whichever method you do, you have to constrain. Then you have got, okay, this is what we discussed. Then we discussed that how to give the discount, passing on. This is what we are doing. Okay. But here, there was no estimated probability was required. In fact, maybe that they estimated the cost. It's the probability, no? They said 22 lakh is the cost, 50,000 first year, second. They estimated it. That means they must have applied a probability there. So second, after variable consideration, we will go to significant financing component. Okay, understand the concept of significant financing component. Now, significant financing component can take two forms, only two forms, understand. There can be either advance payment to the customer, from the customer, or there can be a deferred payment from the customer, that's it. Because if the payment equal to delivery, where is the question of financing there? So in this question you need to see who is financing whom. If the customer pays you in advance, he has saved you from going to the bank, taking a loan so that you can manufacture. That means it is an interest. That's why it will have an element. If the customer pays you in advance, no, definitely there would have been an element of interest. What you need to check, is it significant? If yes, you have to remove it. Similarly, when you give credit to the customer, in fact, you are giving him credit so that he will not go to the bank. You will have a finance income there, interest income. So financing component, if it is significant, you have to separate it from the transaction price, because you cannot tell it is a revenue, no. It is revenue, but which revenue? Interest revenue. As per Schedule 3 format, interest revenue will go under some other head. You cannot show under revenue, no. It will go into other revenue, other incomes. And it will have your implications on calculation, borrowing cost. One portion, if it is related to the borrowing, it will go to the borrowing cost capitalization. So intention of the parties also has to be considered. Why such deferment happen? It simply don't tell that everything deferred means there is a financing component. So if the deferment is not to compensate the time value of money, there is no financing component involved, even though it is something very significant. Like for example, I will say that you have to construct this house. and for next 2 years, I will not pay you 20% of the total price. I will not pay. I will pay you only after 2 years. Why? Why I am withholding that? I am withholding to see that the quality of the work is good. Because if the quality of the work is not good, I am not going to pay you this. Which one? A retention. In construction contract, we have a retention, no? If that retention is done, definitely that retention will have your interest component. No, but you should not calculate it. Why? Because your retention is not to compensate for time value of money. Your retention is done for some other purpose here. So that's the performance bonus is payable at the end of the contract. You don't pay right now, or you hold that money to check the performance. So no financing component is going to come. So there can be only two scenarios. Advance payment can be there, or delayed payment can be there. If there is an advance payment, you will have an interest expense, and if you have a delayed payment, that means if you sell on EMI, there will be interest income. Now the standard has given one practical expedient for our benefit, for the accountant's benefit. They say that entity need not adjust the significant component if the customer pays within 1 year of transfer of such goods and service. Good. They say that, look, significant financing component generally you calculate by discounting the cash flows. What is paid after 2 years or 3 years? If something is payable less than 1 year, and this type of practical expedient we see somewhere else also. In lease, we have seen that there are two exemptions given. One short-term lease, another is one is for short-term lease. You need not apply lease accounting. You need not check does that contain lease. What is that another exemption? It's not a practical expedient. It is an exemption. Correct. Low value items. Low value. Small time. So first thing, what you need to check is delivery equal to payment. If yes, no question of financing. That means step number in transaction price, this particular thing is not applicable only. So in everything, see, I am telling you a format also at the same time. When you read any question, okay, in fact, every 5 steps will be sitting in that question. But later part of the question doesn't, see, every question focuses on one element. Some theory questions focus only on the finance, what is that called, performance obligation. You need not talk about transaction price and all. Something will talk only on the transaction price. In that transaction price, only on significant financing component. So you have to understand by reading the question, which is that heart of that question. So if the interest is not significant, then also you need not remove. It is not for time value of money, don't need it to remove. It is less than 12 months because of practical expedient, no need to remove. But if all these conditions fail, yes, then you have to remove the significant financing component from the transaction price. Are you clear? Yes. Now, which interest? Yeah. Delivery payment means on one hand you give the material, on another hand you take the cash at this point of time only. It's called cash sales. If you say cash sales, there is no, but you take money, you didn't deliver, it is a customer advance. Then you have to test, is there any significant financing component? Or you delivered, customer didn't pay, check significant financing component. So every question till now what we have come across, it was fairly simple. You didn't deliver, customer didn't pay. So we have to check now those cases where financing components will be there. And let us understand how to remove also. Now which interest rate has to be taken? See, I told you there can be only two scenarios, advance or sold on sale on credit. If it is advance from the customer, you have to check the incremental borrowing rate of the entity. Again, you need not have any headache. They will not fool you here, but understand the concept. Why? Because if you would not have got an advance, what you would have done? You would have taken a loan from the bank to manufacture the product too, so that you can deliver. That's why you have to always give priority to incremental borrowing rate. If it is not there, go for the implicit interest rate. Means in this contract of sale, how much IRR is there? That you need to take. If you sell on credit, then you have to take a market rate of interest in separate financing transaction. Why I should sell on credit, Baba? Instead I can give loan, no? Which one? Do we come across anywhere else this concept of incremental borrowing rate? Where we are coming? Lease only. In lease also same concept we have got. There also have to give preference to incremental borrowing rate, because as a lessee, if I don't take it on a lease, what is the alternative option for me? Take a loan and purchase the asset. You are enjoying it as if you have purchased it. That's why they say go for the incremental borrowing rate. See, students, this is the beauty when you ask why it is like this, what is the logic behind it. Then suddenly one conceptual question comes, you understand what to take. Otherwise, you memorize simply, okay, every take this borrowing rate, you may end up getting confused there. You understood the logic, no? Now, why I need to take a market interest rate? Because it is a separate finance. I cannot go and check my customer's incremental borrowing rate, no? When I give it on credit, so I will look what is the alternative interest rate. If this is not there, then I'll go for the IRR. So what accounting entries are going to come if there is a significant financing component? See, if I have received an advance, my accounting entry will be I have received advance from the customer. What is my accounting entry? Bank to contract liability. You didn't deliver. And on the day you deliver, you debit the contract liability, debit the interest expense, and credit to the revenue. And this, if you sell it on credit, today only you recognize customer to revenue. Why? Because your performance obligations are complete. So you are eligible to recognize revenue today only. Here you didn't recognize revenue because you didn't perform performance obligation. And when customer pays you money, bank account debit to customer, but he pays more than what you have debited today, differential will go to interest income. Are you clear? Okay? Yes. So now we will move on to some theory questions. Perfect, no students? Now you should apply. This is what we have discussed is a concept. Now the time comes for application. At the same time, you have to learn the language also, how to present it to the institute. Okay, done? Can I proceed further? Yes. So the first question, this is an MTP question also. So wherever you see illustration and MTP, no, it is a highly probable question. I have given the marks which has come in the MTP. NKT sells a product to a customer for 1,21,000 that is payable 24 months after delivery. So by looking at this first sentence only, you must understand that this must be 115. And is it an advance money or selling on EMI? Selling, because you have already sold, no? And customer is going to pay you after delivery, that too 24 months. Can you apply practical expedient? No. The customer obtains the control of the product at the inception only. The contract permits the customer to return the product within 90 days. Okay, one more fitting they gave in the question. What is that? It is called a sale with the return. We have not discussed now, we will discuss at the end. There is a separate accounting for that. The product is new and entity has got no relevant historical evidence of the return and available market evidence. What does the meaning of this? Now the sale with the return makes your consideration variable. Why? Because within 90 days he can return, no? So the standard says that whenever you sell with the return, when you give that option to them to return back to you, your consideration becomes variable. Now you have to estimate whether he is going to return it or not. And you have to see how many people you think will not return to you. That much revenue only you should recognize. Now what do you think? Is this customer is going to return or not return? But up to you read up to here. What is your understanding whether the customer is going to return the material or is not going to return the material? Huh? Sorry? Loudly. It sounds like equal chance. Huh? Is not going to return? Okay. My point again, I should be more clear in my question. Does entity know or entity thinks the customer is going to return this or he is not going to return this. Okay, you read it. You are given, but even if see every option, everybody will give you an option. Will you go and return everyone? Amazon, you have got anything you buy, you got an option. Did you everything you return? No, no. That means somebody applies a probability. Now this entity doesn't know whether he is going to return or not. When you don't know, should you pass revenue entry or should you not pass revenue entry? Not pass revenue entry. That's it. That's what they say, that the product is new and they don't have any historical experience or evidence of the product returns or other market available evidence. So right now I cannot predict whether the customer is going to return to me or not. I don't know. This is a new product. Because of this, first 90 days, even though I have sold, my performance obligation is fulfilled today. How many performance obligations are there? One. Distinct or series of distinct? Assume to be distinct. Now, I have fulfilled my performance obligation now, but I can't pass revenue entry now. Why? Because I don't know whether he is going to return to me or not. So I have to wait for next 90 days. So my accounting entry will happen only on the expiry of 90 days for revenue. The cash selling price of the product is 1 lakh. That means if delivery was done right now and if cash payment was done right now, he should have paid me 1 lakh. But what is going to pay me? 121. What is the difference? Interest expense, interest income for you, which represents the amount customer would pay upon the delivery of the same product, otherwise identical contract. Entity's cost of the product is 80,000. Why they have given? They have given it because of the return. I will show you the accounting right now so that later you are very clear about it. The contract includes an implicit interest rate of 10%. That is interest rate of 24 months discounted 1,21,000 to the balance. That means at what is the rate of interest at which 1,21,000 will be equal to 1 lakh? 10%. Is it an incremental borrowing rate or incremental, what is it called? Implicit interest rate? Implicit, they said no very specifically. Suppose two rates are given. Which other rates would be, they would have given you? Market rate of interest. They would not have told you incremental borrowing rate. Why they will not tell? Because it is not an advance received, no. Understood? So analyze the above transaction with respect to financing component. Question number 1. Compute the amount to be charged in each year as the financial component. Okay, in the study material question there is only analyze, but they have done the solution also, compute also. In MTP, compute came. So very clear, there is a financing component. How do you write it? You say that the contract includes significant financing component, because 1,21,000 is a very big amount. This is evident from, how do you know? It is because there is a difference between 1,21,000, which is the transaction price, and the cash selling price of 1 lakh. And the implicit rate of interest will be 10%, which reflect a separate financing transaction between entity and its customer. Thus, until, okay, this is one part of the question. Since until the entity receives the cash payment from the customer, interest revenue will be recognized, and for this effective interest rate will be used as per Ind AS 109. Why? Because you have financing component is that means you have to account at a present value. That's it. Okay, so they have not done, they have given only compute, okay, but they have not computed. This is what they have told. Even in exam they may ask you this only. Can you tell me the entries, journal entries? See, today you sold. What entry you are going to pass today? Customer account debit. How much customer account debit? Should I debit customer? Why? Sorry, yeah, a little loudly. Huh? Receivable. Do I have a contractual right to receive cash? First 90 days I don't have a contractual right to receive. That's okay. First, see, he has got a right to return it back. No. Okay, I can say if first 90 days I don't have, then I will say contract asset. And on the 90th day, I will say customer account debit. That's the, I will tell you later. That's the difference. So, but it is the contract asset for you. So, what is the first entry you will pass? Customer account or contract asset account debit. Okay, we can use the word contract asset. How much? 1,21,000, 80,000, 1 lakh, 1,21,000. It should be 1 lakh. Okay, we will see them. It's 1 lakh. You see, if I look at, okay, forget about this. If I, whatever it is, contract customer, it's the present value of the future cash flows. No, this is the fair value. If it was customer and you would have accounted as per 109, 109 says what? Fair value. Forget the second leg. Second leg is told by different standard. First leg speaks about comes to 109. No. Which one? Interest or a customer is also a 109 subject matter. No. Okay, you say, okay, what is your today's day contract asset? Contract asset is a fair value. That for this, that's what you are telling. No, it is coming from another another aspect called right to return or right of sale accounting. That says that, look, you will pass the accounting entry contract asset. Yes, your observation is correct. It's contract asset account debit to customer contract liability. Why? Because I have delivered my machine. Then I have to reverse at the same time, whenever I pass a sales entry, as per Ind AS 2, I need to pass COGS to inventory entry. Inventory goes from the balance sheet, COGS will reduce, COGS will hit. This part we will discuss in Ind AS 2. How much? 80,000. But since this is my asset with someone else, it's not my cost, no. That's why I will say one more item called the inventory right to return, which is shown in the balance sheet, to COGS. Which one? Yeah, what is your doubt? It's at a fair value. Because your cash price is the fair value, no? After 2 years. Hmm. 1 lakh. Its present value is 1 lakh. So you see now, as for how we proceeds. Now after 90 days, okay, so now your contract liability will get debited. And your, okay, maybe you will pass one more entry, customer account debit to contract asset. Because now he becomes a customer. You have got a right to receive. Contract liability account debit to revenue. How much? 1 lakh. See, if you say 80,000, how can you take 1 lakh to the revenue then? What you will do extra amount? So it should be at a fair value on the date of transaction. Now, yeah, and this is told by your that sale of right to return accounting. Now the moment after 90 days, right to return is gone. So you reverse this entry. Now at the end of the first year, I will debit customer to interest income. How much? 10,000. At the end of second year, customer to debit to interest income 11,000. So my customer debit 1 lakh, debit 10, debit 11. So customer is credited 1,21,000. He will pay me cash 1,20,000. You understood the flow of entries? Clear? Yes. Company Z, a developer and manufacturer of defense system that are primarily a tier 2 supplier of parts, integrated system to original equipment manufacturer. Some story. There is one supplier, defense system, he is supplying to OEM. Now company Z enters into a contract with the company X for development and delivery of highly specialized missiles to be used in the X platform. X company is a defense company. They are making missiles and selling it to the governments of different countries. Now Z is a subcontractor type of person. So he has entered into a contract to develop a missile to be given to X, which in turn X will sell to the governments. Now as part of the contract, X agreed to pay Z cost plus award fee up to 100 crore. So what they will do? Your cost 100% they will reimburse. Plus one award fees they will pay. Is it fixed? No, it's variable. How do you know? It is up to. That means you may not get also. Now the consideration will be paid by the customer related to the cost incurred near the time. As and when you incur, it is reimbursed immediately. However, 100 crore award fees is given only upon the completion of the development and test fire missile, which is 16 months from now. The contract specifies Z will earn up to 100 crores based on the X assessment of the Z ability to manufacture, final weight, velocity, accuracy and all. It's like a bonus. You give me fantastic missile, you will be given 100 crores. You don't give me any fantastic missile, you will be just reimbursed with the cost. But this payment is not going to happen on a staggered manner. It is only once the final missiles are ready, it will be tested. Partial award fees may be awarded based on the predefined skill. It may be, it is out of our wish. Assume as company Z assessed the contract under 115, because you need to assess why variable consideration is there, and determine the award fees represents the variable consideration. Do they need to tell you? No, while reading only you understood it. Based on their assessment, they estimated 80 crores in the transaction price related to the variable consideration pursuant to the guidance of 115. You will get only at the end, but can you include it today only? You can you start, see, they will reimburse you cost. Does that mean you should recognize only cost? Should you not? Is this performance obligation over a period or at a point? It is over a period of time. So you may be using cost to cost input method, like we have done that construction costing in the previous step. So you will recognize your revenue from time to time. You will not wait up to end of the year to recognize that 100 crore. So on day one, how much you think that you may get this consideration? 80 crores. Which method you used? How many methods are available to estimate this? Most, and have they told? No, but it is implied that one of the two methods they have used and they have estimated 80 crores, and you have to, from time to time, you have to start recognizing a portion of it. Your estimation may change. When the estimations change, you apply cumulative catch-up adjustment method or YTD method to adjust that cumulative revenue. Further, the entity concluded that it should recognize revenue over, see, now you understand the language here. They said, I should recognize it over time. How many conditions are there for over time? 3 conditions are there. Do you remember those 3 conditions? Over time, anyhow, the last we will discuss. Customer receives and consumes the benefit. Is it received and consumed immediately? No, because when you will consume? Only when the missile is ready, no. Second, control of the asset is obtained as and when it is manufactured. Now, as and when the missile parts, like the bottom portion is built, who is obtaining the control over it? X. Because they said this missile has to be done on the X platform. Understand, see how what implications are there. They may ask you to analyze, no? Ulta same in the examination, they may twist this question and say, tell me whether this performance is obligation over a period or at a point in time. Then you have to understand this one, catch this word, and they say, since the contract is to develop the asset on the X platform, as and when you have built the foundation, the case, the top, who is getting control over it? X. That's why it's the over a time. How many performance obligation? Is this single or multiple performance obligation? Is this missile development a single performance obligation or a multiple performance obligation? Multiple performance obligation. Okay. Performance obligation, we will go to the step number 2. How many distinct are there? At a product level, multiple distincts are there because your foundation, this base is there. Is it required that only Z has to develop the base? X can get the base from someone else and tell that you develop the case. Case is there, top is there. Is it required the top has to be developed by Z only? Now, individual products, I can get it and assemble it from different places. Specialized missile, but the components, that will come to that, no. Why it is specialized? Because the individual, see what Z promised, say for example, there are in one missile, there is a base there is a body and there is one head. There are three distinct goods. Followed? Assembly, 4. That means there are 4 promises which are very distinct. Somebody has got this. If they call Z, can you come and assemble? Will Z assemble it? Yeah, that will assemble, no? Some other person's missiles are there. Can you come and assemble? I will tell you, no. Baba, see, understand first of all, components, even Z doesn't manufacture, he also purchases. It is like you want one special computer. There are 2 ways. You can go and tell one computer guy, give me this special computer. He will get different components and he will assemble and give it to you. Alternatively, in Amazon, can't you buy those components? It's a special computer. Can't you buy the special items, imported items and all? Yes. Can you call this guy and say, sir, I have already purchased from Amazon, please can you assemble and give it to me? He will give, but he will charge for that, no? So what I mean to say, at the product level, there are 4 distinct goods or service. Agreed? Now at the contract level, what happens? Integration, first condition. That's why we call it a specialized machine, because all these are used as an integration and what is offered to you is a missile. That's why they said it is a single performance obligation. See, we solved all those similar question one after another. I am telling you, no, this question may come as a bouncer like one ulta. This is what I am telling you. I say doing this. Suddenly they may twist, no? How many performance obligations are there? You have to tell at a product level so and so thing, at a contract level. Now, since it is over a period of time, you need one input or output method of measurement. So you have used cost to cost input method. You remember cost to cost input method? For this they should have given. No, they didn't give you, but you should have given you cost to cost, like how much is estimated cost, how much cost you incurred. Now what they said, analyze whether this is a significant financing component. At the end, no, story is different only. See, once you understand, get a thorough understanding of individual component, it is again, I am telling you, it's plug and play. Let them mix and give you any question, you should be in a position to do it. This is what I do, I tell you every single chapter. Every single chapter is made up of all small concepts. If you are thorough, let them plug and play. In one consultation, suddenly some other concept they give, and I have shown you. Suddenly they will deferred consideration of your Windows 103. Should you panic? No. For this, you should know what that treatment should be. Then done, no? That is a conceptual understanding. Yes, tell me. Is there a significant financing component? What is a practical expedient? Practical expedient is for what? Time value of money or something else? No, this is actually, this is misguiding. I misguided you somewhere by showing this. Okay, no problem. See, practical expedient is not applicable because practical expedient is meant only for these cases where the payment is less than 12 months. That is, see, that's why you should not say that because of the practical expedient and time value money. You cannot connect a time value of money to practical expedient. Practical expedient is meant for payment less than 12 months. It is not a practical expedient. Here, the question of financing component doesn't come at all. Why? Because the withholding is not for time value of money. I'll show you, no? When I see practical expedient, I said customer pays within 1 year. This is what I said, intention to be checked. What is your intention to hold? For a bonus purpose. Followed, no? So you have to say that you didn't receive the consideration award fee. It is a significant financing component. Is there or not, you need to check. Okay. Intention of the negotiating award fees is to have high functioning missiles. Contract does not contain a significant financing component. Further, as a practical expedient, you need not adjust the promised consideration if the payment is done within 1 year of, okay, that part we can apply here, because here we missed it. By looking at the question we will understand better, of transfer of goods and service, not from the contract inception. So from the, once you transfer from there, if it is payment is going to happen within 12 months, then you can apply. So even though this contract is 16-month contract, this contract is of 16 months. Where is that? Somewhere they said no. I remember somewhere last sentence. Okay, where somewhere we have said 16 months. 16 months is from the inception of the contract. That is the deadline for the contract. But once you deliver, from there you have to check whether within 12 months I need to receive it or not. But anyhow, in the first instance only it fails. So you need not check the practical experience. If I go back to my chart, it fails at the here only. Where is that? It is not for time value of money only. Then why you need to check whether less than 12 or not? Are you clear? VT Limited enters into contract with the customer to sell the equipment. The control is transferred when the contract is signed. So this is single performance obligation, and performance obligation is complete. Now it is transferred and closed. It is at a point in time. The price stated in the contract is 1 crore plus 10% contractual rate of interest payable in 60 monthly installment of rupees 2,12,470. That means every monthly EMI you need to pay. For how long year? 5 years. Can you apply practical expedient? No. Is there a time value of money? Yes. That means we need to separate. The present value of the 60 monthly installment discounted with 14%, which is the implicit rate, this is the contractual rate, is 91,31,31,436. In fact, this is not given in the question, but in the answer of the study material, this is they have told. So probably in the examination they will tell you. Can you calculate the present value of this EMI of 2,12,000? Half an hour you have to spend there in the examination hall for 60 installment, finding out the present value of 2,12,000. So they only told you what is the present value of this 2,12,470. Now the difference between these two numbers is your financing component. Determine the discounting rate and the transaction price when contractual discount rate reflect the rate in separate financing arrangement, and the contractual discount rate do not reflect the separate financing arrangement, that is 14%. Suppose if my contractual rate and the market rate are same, what is the discount rate and the transaction price versus what is the other scenario? Okay, this is another learning. The standard says that the contractual rate of interest reflect the rate in the separate financing arrangement at the inception of the contract. Thus, the contract reflects the credit characteristics of the customer. Thus, the entity shall recognize revenue equal to the cash selling price, fair value of the equipment, that is 1 crore. If your contractual rate is equal to your market rate, what is the present value of all your future cash flows? It is equal to the cash price. Today, cash price is 1 crore. And if you discount at a 10%, all your future cash flows, which is equal to contract rate, in 109 we discussed it. When the contract rate and the fair value rates are same, your transaction price is equal to the fair value. That means you don't have any interest income and receivables will be accounted as per 109. That means today you will pass 1 crore entry only. Going forward, the 10% interest rate you will charge calculating interest. Interest will be calculated at the rate of 10%. But if the contract rate and the actual market rates are different, which one you will choose? You will choose the market rate, 14%. In that case, revenue will be recognized not at 1 crore, revenue will be recognized this, because this becomes the fair value. If contract rate is equal to market rate, 1 crore becomes the fair value. Again, theory question. So it is significantly differing from the separate financing arrangement. So there is a fair value is not less, will be less than 1 crore, so fair value will be 91 lakhs. Thus, you have to recognize interest and receivable as per 109 by recognizing 91 lakhs. Again, you have to prepare one amortization schedule. Again, you can give a low priority to this. Yes, now let us see, calculate some problems. We can do some, yeah. Okay, so you enter into contract today. 1 minute, huh? Yeah, today you enter into contract. Did the material transfer? No material transfer. Okay, this becomes called an executory contract, where both the parties have not done their job. Mm. Okay, now when the work is 50% complete, okay, so payment will happen. Okay, which payment? Your whatever cost payment or cost plus payment. Okay, 50% payment is done. But now question comes: it is not delivered because the product is not ready? Okay, then okay, now the product is transferred at the end of 12 month when the 100% work is done. At that time, 100% payment is done. Okay, we can apply, no, because here you have received an, okay, no, practical experience comes once the payment material is delivered, from there 12 months concept applies. Suppose you have delivered here, till now you didn't receive any money, you delivered today and he is going to pay you after say 2 years this money, like we have seen, no, 1 lakh was the price if you have paid right now, but he agreed to pay you 1,21,000 after 2 years. Now you have got a financing component. If he'll agree to pay you 1,10,000 at the end of the year, practical experience not required. You can include that 1,10,000 as part of your interest only. So today only you can pass a revenue for 1,10,000. You need not separate it. Okay. But when you talk about an advance payment received here, yes, again, it goes with the judgment. Again, whatever, in both the cases, if you feel it is not significant, you need not remove it. If you feel, if it is a really big amount, okay, and this, the nature of this transaction is more like a financing only, or why he paid you 50%? If you don't have paid, because can he start using it? No. He has paid you to finance you, so that you can complete that balance 50%. If that is the understanding, then you have to remove the financing component and account it. Again, see, this is more like who has to check this? Auditors have to check it. And auditors are there at the side there, understanding what actually in the business happening. Yes. See, whenever you receive, you start incurring the cost. Again, whether it is a contract asset to, bank account debit to contract asset, contract liability, no? Versus bank account debit to revenue. That depends upon whether the performance obligation is over a period of time or at a point in time. See, you have done 50% of the work. Work is not complete. The customer is not able to enjoy that benefit of whatever your work. Like up to roof you didn't do. Up you have brought one house. Understood, no? You have completed only the walls. Now can the customer come and stay? No. Has the customer paid you? Will you not recognize revenue? That's why it all depends upon when the work is not complete. Say work is 50% complete. Now customer makes me a payment. Whether should I recognize revenue for that 50% payment, or in that 50% some portion as a revenue, or whether should I treat entire 50% as a contract liability, that depends upon whether the performance obligation is prepared over a period of time or at a point in time. If it is over a period of time, OPT, then I can use cost to cost input method and start recognizing my revenue. That's why accounting becomes very tricky there. I have to see, my information system should be very good, so that I keep track of, because something that I recognize revenue, it is not what I bill to the customer, no. And there is one more thing, we'll talk about this one, practical experience. Practical experience says that when there is a over a period of time, you can recognize revenue in the pattern you bill to the customer also. If you have billed 50% to the customer, you can recognize 50%. That becomes capital work in progress. which is governed by Ind AS 16. If you are, it's a capital work in progress. No, did you receive anything from the customer? Yeah. See, what you can do, again, even though you have not received anything from the customer, you can start recognizing revenue, no? Based on your proportionate work completed, you will start recognizing revenue and debit through the customer or contract asset, whatever. Now, it will become stock in trade only once the work is complete, right? Because what your Ind AS 2 says, half done work, is it ready? Is an inventory for you? Or it is an inventory, we can say it is an inventory in process. Like when you say Ind AS 2, Ind AS 2 speaks about raw material, work in progress, FG. So if you are talking I am a real estate, it is this. If you are not a real estate, Ind AS 16, capital work in progress. Very nice, no? And I am also very happy for this type of questions, because see, that's the purpose. Like you open your mind, think what happens in the different scenarios, different situations. Apply, no, and see a small line, small sentence here, somewhere has got other implications there, no? And once you understand in totality, then you get that from inside, one excitement, enjoyment, happiness to know something. It's an empowerment, understand it. Because all these things can be asked in your interview, in upcoming interviews, or somewhere somebody may ask you. Yes, nice. Okay, so we'll solve the problems now. Take out question number 7. X is engaged in the manufacturing and selling of designer furniture. It sells the goods on extended credit. Okay, the moment you see this sentence, see, first of all, I told you, no, covering every aspect, they will not ask you any question. No questions are available, starting from analysis of the contract till revenue recognition. Whatever question they will ask you, it is focused on one particular aspect, either transaction price, variable percentage changing, financing component. So it sells goods on credit. It sold furniture for rupees 40 lakhs to a customer, the payment against which is receivable after 12 months with the interest of 3% per annum, and the market interest rate is 8% per annum. So calculate the revenue to be recognized for the above transaction. So this question can come for 6 marks. So what is my transaction price here? Sorry? See, no, don't mistake. Transaction price is different from fair value. Transaction price is nothing but contract price, which is fixed. I can go to the court of law and get that money. Fair value need not be transaction price. Fair value is equal to transaction price if the interest rate involved there is equal to the market interest rates. Otherwise, your fair value will be different from transaction price. This is the crux of what we have learned in 109. Why we should differ here? Okay, what is my transaction price here? One number you should tell me. I want one number. You should tell me one number here. What is my transaction price? Okay, 40. Any other numbers? Please look into it. Sorry? First of all, are you very clear? What do I mean by transaction price? Are you very clear? What is transaction price? Contractual price. That means more than that 1 rupee customer will not pay me. And if he pays less than that 1 rupee, I will catch his neck. 40? Baba, you sold for 40, but what he pays you, the payment against which is receivable with the interest of 3. Are you not paying 40 plus 3% interest on 40? Are you not paying? See, my point is, are you not paying a transaction price which is equal to 40 plus 3% interest for 1 year? 41 lakhs 20,000, 41.2 is my transaction price. More than that 1 rupee customer will not pay me. Less than this 1 rupee I will not accept it. Now this I need to discount to the present value at 8%. Followed? Okay, so do transaction determination of the fair value. Not here, everywhere transaction price is equal to contract price. But in Ind AS 115, we don't use the word called contract price. We always call it transaction price. If it is off market, then it will, if it is at a market terms, it will be at a fair value. If it is at off market term, it is at not at. That's what in the previous question we discussed, that 1 crore and 91 lakhs. So, what is my transaction price? Calculation of fair value. Calculation of fair value, which includes two calculations. One, finding out the transaction price and finding out the present value factor. Transaction price will be 40 lakhs plus into 1.03. 41 lakhs 20,000. What is the present value factor at the market rate of interest? Why market rate? Because this is what I am selling it at 8%. It is 1 divided by 1.08, which is 0.9259. Therefore, what is the fair value? 41.2 into something. What you said? You said no. 38 lakh something. Yeah, very good, very good. So 38 lakh 14,007. So how much is the interest component, which you need to separate now? You difference between 41.2 and 38.1, 3 lakh 5,300. Alternatively, if you prepare an amortization schedule, you start with 38 lakhs 14,700 into 8% will give you the closing balance of the asset at the end of the year. Are you clear? Yeah. Sorry? No. Therefore, right, rupees 38 lakhs 14,700 will be recognized as revenue, and rupees 3 lakh 5,300 as interest income. See, before this standard, smart people used to recognize 41 lakh 21,000 as revenue entry. Customer to revenue 41 lakh 20. Nice, no? Why? Because as per contract he has to pay me 41 lakh 20. Even though you don't include that clause called with including 3% interest. As per payment terms, you have to pay after 1 year. How much? 41 lakh 20. So what entry will pass today? Customer account debit to revenue 41 lakh 20. But standard said no. That is a contract price. Does it include significant financing component? After all, the understanding the time value of money, intention to retain, intention to pay after, and if answer is yes, find out the present value at the market rate, bifurcate that into two portions, pass the entry only for the present value of the future cash flows. Even in Ind AS 16 also this is what we have done. Perfect. See, if this standard was not there, okay, we'll pass the journal entry now. Then at that time we'll understand. What is my first entry at the inception of the contract? Customer account debit to revenue. Why? Why you recognize revenue? Because you have fulfilled your obligation. How much? 38 lakh 14,700. See, Dhanashri, if this standard was not there, entry was same. This amount was 41 lakh 20. Telling this is my transaction price, this is what he is going to pay me. But today's standard says, Baba, what he pays I understand. When he pays that you tell me. You pay after 1 year. What accounting standard will tell? Nothing, silent. Then argument happens between an auditor and this. No sir, this is our practice, this is. But today's day, that argument doesn't happen, because I will go and open para number 56B of Ind AS 115 and I'll show that para number. See, this is what your standard says. Will you ask, why should I follow that standard? Then I will go and section 133 of the Companies Act, 129 of the Companies Act, and say you have to follow account Ind AS. That is Ind AS, no? Yeah, this is the Ind AS we have prescribed. So you have to follow. And if you don't follow, I'm going to qualify my report, because you are hiding the sale is not true and fair, because this is true and fair. This is acceptable, not hidden anything there. Perfect? Yes. So what is the entry at the end of the year? Customer to interest income, or you can have passed one single entry, bank account debit to interest income to customer. Are you clear, students? Yes, so we'll move on to the next question. ST Limited enters into a contract with the customer to sell an asset. Okay. The control of the asset will transfer to the customer in 2 years from now. That is, performance obligation will be satisfied at a point in time. That means when you can start recognizing revenue, not over a period. That's what we discussed some time back. No, advance received 50%. This is that example. That means I cannot recognize any revenue till end, but it will take me 2 years to complete this product. The customer gives 2 options to you. The contract includes 2 alternative payment options. One option, you pay 5,000 2 years from now, when the customer obtain control. That means right now I entered into a contract to develop this missile or whatever it is. As per the contract, after 2 years I will give the machine, you pay me 5,000 rupees. Or you pay me 4,000 rupees now, the moment contract is signed, that's it. I will give you machine after 2 years. When he will come after 2 years only. That's why till now, for next 2 years, it is called executory contract. Executory contract means there is no accounting entry required, because neither you have performed anything nor they have performed anything. Should I apply Ind AS 109 for executory contracts? Ind AS 109 for executory contracts for purchase orders? Is it a derivative contract? When customer pays me an order, is it a derivative contract? It is a derivative contract, no. That means today you have entered into a forward contract where you have agreed to deliver in the future, against which he will pay you in the future. Price is fixed today. No, first of all tell me, is it a forward contract? If it is a forward contract, it is derivative, no? Should you apply 109? Or can I apply own use exemption? Own use exemption. You remember? Is this contract settled net for cash? No. Is the contract term says that at the end of 2 years, if I don't deliver the machine, the value of the machine equal to the market price minus 5,000 you have to either party of settle. That means it is a derivative contract. So, followed, no? Is there a written put option there involved? No, those 3 conditions are there in Ind AS 109. So, those 3 conditions you have to apply to this. Again, I am just reminding you 109. There is something called own use exemption. We have done that. You have to again, there were 3 conditions you have to apply and see whether derivative account to be applied or not, and the answer is no. Why? Because there are no such specific terms like this. So it is a own use, because why they gave the order, why the purchase order was placed? For your own use of that asset, not to trade in this. What do you mean by cash settled net in cash? Cash settled net in cash means three. One, there is an express clause that it will be settled net in cash, or there is an implied practice, or the asset is readily convertible into cash. None. That's what I say. No, there's. But will you say like this? None. You have to write those 3 points now first and apply to this given case, and then say, in this given case, 109 doesn't become applicable for first 2 years of the contract when it was in status of an executory contract. Understood? Yes, but that is not the question here. Let us come back to 115. So, which option the customer has chosen? Second one, the customer elects to pay 4,000. Now, is it become an advance payment? Where the financing component is very significant? Because 5,000, 4,000, God knows, no, it is 5,000 crores versus 4,000 crores. Now, ST Limited concludes that the contract, they only concluded that there is a significant financing component because the length of time between the customer pays and the asset is transferred, as well as the interest rate, all these factors they considered. So, which rate of interest they should have given me? Incremental borrowing rate. But if it is not available, implicit rate only we can take. So, 11.8 is the implicit rate of interest at which the interest is necessary to make the alternative payment options equivalent. That means, if you are going to find out the present value of this 5,000 at 11.8% for next 2 years, it will be equal to 4,000. That means, it is the implicit rate where it doesn't make any difference to anyone, whether you pay right now or whether you pay after 2 years. However, the entity determines that the rate should be used in adjusting promised consideration 6%, which is the incremental borrowing rate. So, which one you should be using? First, always give the preference to this. Now, pass the journal entry showing how the entity is going to account the significant financing component. So, which rate you should use? 6% you should use, not the implicit one. If this is not available, then you should have gone. Okay, right? Solution. As per Ind AS 115, interest expense to be recognized at incremental rate, borrowing rate, first preference, or implicit rate. In the given case, implicit rate will be used. In the given case, incremental borrowing rate of 6% will be used. So, first you will tell which rate you are going to use. Okay, now tell me students, at the contract inception rate, what accounting entry you are going to pass? Bank account debit to contract liability. Okay, so you will pass bank account debit because you have not transferred it. You will consider at 6,000, 6%. And what is transaction price here? 4,000 or 5,000? Are we supposed to find the present value of 5,000 at 6%? You didn't ask me this question. No? Previous question, you have found out the present value of that price. Correct? Should I find out the present value? We should not find out because my transaction price itself is 4,000, which is paid right now. If at all transaction price was 5,000, that 5,000's present value. See, you have to see finally what customer pays. It's the present value you have to find out. Since customer is paying right now Finding out the present value is meaningless. No, this itself is the present value. Now you have to find out the future value. All the problems we have found out where the product was sold on credit. This is the only problem where we are finding the product advance cash was given. It's the present value, it's the discounted value. Now you are going to what is it called? Unwind it. Understood, no? Where you received it? You received it. Yeah, agreed. What you did with this money? You saved your interest cost, no? If this was not received, in your P&L account, one new expense would have come, no? What is that? Interest expense. And in balance sheet, one liability would have come called bank loan. You avoided that. How? By taking advance from the customer. But I will not allow you to avoid all those things. Whatever true and fair you should show only. Only thing is, your bank loan will not come, contract liability will come now, next 2 years. So at the end of the year one end, I will pass interest cost or finance cost account debit to contract liability because you didn't pay it. How much amount? How much is the amount of my interest cost? 240. How did you get this? 4,000 is the opening liability, amortization schedule, simple. Debit to contract liability. Again at the end of the year, what is same entry you are going to pass, correct? Amount. $254. Because this becomes accumulated now. And if instead of this you would have taken a bank loan like with this effect, it would have happened the same thing. You would have taken one bank loan today, present value of the future cash payments. That's what they said. If you take advance, go for incremental borrowing rate. If you give it on credit, okay, you take it on the market rate. Now market rate, if you give on credit, 5,000 would have been the value. You would have taken at the implicit rate there. At the end, contract liability account debit to revenue. On the day you transfer the control, you will take contract liability account debit to revenue. Yes, so before we proceed to the next question, yes, we are done. This is all about your financing arrangement. Now we'll again go back. And I hope you are very much clear about the financing component. Third is the non-cash consideration to the customer, from customer. See, some of the transaction customer may pay other than cash, like we discussed it, car. You will go and exchange your car, exchange your old mobile phone and pay some additional cash. So when you pay something for cash, there is no headache of measuring the transaction price. What if customer give his old mobile phone, on that he will pay 10,000 rupees and buys one mobile worth 15,000 rupees. What is the transaction price? Now see, forget about the cash. Cash is very clear, 10,000 to definitely. What is the value you will consider for this old mobile? If it was PP, it is an actually it's like a barter. What rules I would have applied in PP? What is the rule of barter system in PP? First thing what you will consider? Commercial substance is there or not? If no, book value of the asset given up. If yes, fair value. Now, first preference you will give the fair value of the asset given up. Like if not there, fair value of the asset received. If both are available, fair value of the asset. Here it is a ulta. Because see, there you are holding one asset. You are not selling that and you are getting another asset and it is not your business. See Baba, here you are a seller. For you, the non-cash consideration what you receive, you have to give preference to the fair value of the asset received, no. You should not give the importance to fair value of the asset given up. What you are giving up? Baba, see, This is you, customer. This is a company. Who has to recognize revenue recognition? 115, who should apply? This person should apply. He gave his new car. You gave his old car. The value of the old car, how can you derive from the value of the new car? Because part of the consideration is paid in cash. That's why the seller should give priority to the value of the asset received. This is the opposite. That's what I'm trying to tell you here. So 115 excludes non-monetary exchange between the same line of business. That means I will give you, say, one car, you will give me car back. That means it's no commercial substance. Customer, it can be anything. It can be PP, you wanted to resell it, leave it. You think from the company's perspective. And why did they say exclude non-monetary exchange of the same business line? Have you gone to purchase chappals, sandals? That person doesn't have. Madam, please sit here. When you go to buy sandal, he doesn't have, okay, some variety. You tell, I wanted that type of variety. You sit, madam. Now I'll go to the godown and bring. Correct? He goes out. Has he gone to the godown? No, he has gone to another shop there. He brings from there and give it to you. Followed, no? Now, will he pass one sales entry there, the next shop owner? No, because the understanding is, look, if I give this, no, I will replace it. I will not give cash to you. It is not an inter-shop sale there. It is a barter where I will take your shoes, I will give worth my shoes. No, that's why observe next time. What we are learning. You thought, see, these are all called Vyapara Guttu, tricks. You go and ask anything, any vegetable, finished. People say finished. They say, I don't have, they never say that. Followed, no? If you go to any one person, one shop, and say, do you have this? They say, no, yeah, it got finished. They don't say that they don't have it. Why? Because if they say don't have it, next time you will not come. If you say it is finished, maybe you have some other requirement, next time you go there. Nice. No? Other building, yeah. No, that's what, no. And how I know, no? Because now I'm studying marketing. It should be learned. It's a very interesting thing. Because see, again, you have to learn, Papa. For your personal, you are also doing marketing only, no? Once you qualify, you have to market yourself there. Reference fees, so many things are there. Like, again, students, that's what my point is. When you go outside, just observe what you learn here. That's what I observed also. That's what I told you. Whoever drafted this, fantastic commercial common sense. You see exactly what they do is reflected here. Anyhow, we'll go back further. So, barter in the same line of business is not permitted. That means you cannot pass the revenue entries. It becomes one material delivered on, say, return basis. Now, how do you measure the transaction price? Measure the non-cash received at the fair value of the asset received. Don't talk the fair value of the asset given up. Arre Baba, you are giving something very valuable thing, and what you are receiving is some scrap item. You cannot value that scrap at you, whatever you are giving up. No, you are a seller here, 115. If it is not possible, then you have to find out the SSP of the goods and services promised. Say, if it is a completely, see, it's pure exchange. Their mobile, your mobile. Or it can so happen that I am the machinery, I have sold the machinery, and 100% consideration I have received in the form of land. Possible? I sold one machine and they didn't pay me cash. They said, okay, next to your flat, there is one vacant land, no? It is also worth 10 lakh rupees. I have got, say, 1 cent or 10 cents. You take this land. Is it okay, right? Okay, no? Can't it happen? It can happen, no, Baba. Something like somebody, you go and eat in the hotel. You don't have money. What will do? They say, watch. Ideally, they keep this watch. That's a barter. Now, what is the value of the consideration? See, if you don't know the value of the asset received, then you have to value it based on the selling price, not the fair value of the asset given up. And what is the selling price of the asset? Fair value of the asset. SSP, standalone selling price. Now, what if subsequently the fair value is going to change? No adjustment you should do to the transaction price. See, adjustment means cumulative catch-up adjustment, YTM level. They said you should not do if the value changes because of the form. Like for example, you sold some car and somebody gave you L&T shares. They gave you 100 shares, and after 1 month the share price has become 200 rupees. Will you adjust your transaction price and say revenue from sales? No, that's why if the value changes because of the form, do not adjust transaction price. That means revenue recognition entry should not come again. Understood the logic? But if it changes other than form, then you have to do it. Like for example, performance bonus. I say that if you complete this building within say 10 months, I will give you 100 L&T shares. If you complete within 2 months, I will give you 50 L&T shares. Is there a variable consideration? Yes. Is it a non-cash consideration? Non-cash, no. Shares, L&T shares they are giving. That means the consideration takes 2 forms there. Like it is a variable also, non-cash also. Since it is variable, should you estimate? Yes. On day 1, you estimate that I may probably get 70 L&T shares. And you pass one accounting entry for revenue on cost to cost input method or whatever. Suddenly at the end, you realize, oh, no, I may not get 70, I may get full 100 because I will complete it. Then did your transaction price should change? Yes, because this time you should consider 100 shares. Because the variable, the price change, the value of the consideration change, not because of its form, because of your performance. In the first instance, the value change of the total value of the shares change because of the market price. So if it changes because of things which is not within your control, because of its very form, ignore it. That is your fair value. That question comes after you recognize that investor. What is your accounting entry? If you sell machine and somebody gives you L&T shares, what is your accounting entry? Sorry? Investment, L&T shares somebody gives you and you sell your machine. What is your accounting entry? Investment to machine. So going forward, if the price change, what is going to happen? Now the moment you say investment, 109 attracts. Then question comes, FETPL or FVOCI? If it's FETPL, you will take the fair value gains to the P&L. But if it changes because of the number of shares concept, next time when you initially you thought 70 shares, so you passed entry investment to contract revenue 70, and next day you realized, or next month you realized you are going to get 100, again you have to pass investment to revenue, because you got more not because of the market price changes there. Understood? That's it, a very small concept. Non-cash consideration. Understand, production company Y. Now this is an application time, since you have conceptually understood. Sells a television show TV to company X. Like there is one say Kannada serial called, what is that, Srirastu Shubhamastu, for example. Say for example, or whatever your favorite TV show you can give. Now that ZTV sells to say Uday or Z Kannada. Uday TV sells to Z Kannada, something like that. So production company Y, this is a production company. The producer sells a television show, one serial, to one ZTV. The consideration under the arrangement is fixed amount. How much they will pay you for this entire IP, intellectual property? They will pay you 1000 plus 100 advertising slots they will give you. See, they say that, look Baba, it is your serial. If it is very famous, then I will start selling that slot. Otherwise, who is the owner of the slots? Advertisement comes, no in between. Who is the owner of that slots? Who is getting consideration? The TV. Now TV company says, look, I will give you 100 slots. You decide anytime during first 10 minutes, second 10 minutes, and if you want, you sell to any party that advertisement slots. If your TV serial is really super famous, then you can sell these slots at double, triple the price. So this production company says, okay, who has to apply 115 here? Production company. Because he is selling, what is his inventory? The TV serial is his inventory, which is an intellectual property right. Understand, later you have to apply one more principle there, intellectual property right. Now, Y determines that the standalone selling price of the show would have been 1500. If you would have told, no sir, I don't want any advertisement slot, give me full price only. At what price I would have sold? 1500. Based on the market rates, now what is the fair value of the advertisement slot? This 100 slots worth is 600. That's why I agreed. Okay sir, give me that. Because fair value of that slot plus cash what he gives me, it is more than my standalone selling price. Now what is my transaction price? Okay, theory we have to write. Follow, no? See, this is an application. By looking at the question only you understood 1600 and is my transaction price. But how do you communicate to the evaluator? For this you should start. Y determines, okay, here there is no much theory. The transaction price is 600, which is 1000 plus fair value of the slots issued. Otherwise you have to write some theory. I will show you something that same thing. If it is between the same line of business, is it the same line of business? No. What if ZTV gives advertisements, its advertisement slot to Udaya TV and Udaya TV will give its advertisement slot to ZTV? No, that's not acceptable. So if the fair value of the advertising slot you could not estimate, then what's the transaction price? Standalone selling price, that is 1500. If you can't measure it, not what you received it. You received 1000 plus slot, but if you don't know the value, then 1500 is the transaction. Perfect, very clear. Now QTV released an advertisement into Deshabandhu, highly probable question in the exam. A vernacular daily. Paying for the same, QTV allowed Deshabandhu a free advertisement spot which is duly utilized by Deshabandhu. Now this is a transaction between Udayavani and say for example not Vijayavani, TV. One is your TV, another is your vernacular, means your newspaper. They said, look, when I come up with one new, what is that called, serial. In your front page, I will give one advertisement that at 8 o'clock in the night, this serial is going to start from tomorrow in this. In that, when that serial starts, you give advertisement of your newspaper. Your newspaper is best in the world. So it is a barter. Now, how the revenue of a non-monetary transaction in the area of advertising will be recognized? Now, for whom we should apply 115? Both. Because both have sold their products. Advertisement slot is your product. For them also it is an advertisement slot. At what value I should recognize? That's what. Is it in the same line of business? No. That's what I am telling you. This is a tricky question because both are in a different line of business. But when you talk about, you have to exclude the theory you have to explain. 115 excludes monetary exchange between the same line of business. In the current scenario, one is print media, another is the electronic media. So you cannot say both are in the same line. No. Between CTV and Udaya TV, yes, it would have been in the same line. That's what, before this I gave that example. You see, again, I will say both are table. But a table which is used in the office versus a table used in the sales office, both are different class of assets. Followed, no? So somebody should see, this is what management will argue, that both are same media. But you as an auditor, you have to tell, look Baba, you present it, give the proper disclosures there. Because both are different actually. Because what you pay here versus what you pay there is totally different. And the way it appears is also different. Now how to measure? It should be measured at the fair value of the assets received, and if it is not available, then the SSP of the price. Now a telecommunication company entered into an agreement with the power generation company. Now why telecommunication has to enter into power generation company? Because telecommunication requires power. 24-hour power is required. And why telecommunication, what power generation company has to do? Let us see. Agreement provide that A will provide 1 lakh minutes of talk time to the employees of B. And this power generation company will become one hero there in front of the employees. Free mobile for you. 119 applies. Employee benefit expense. Followed, no? your inventory is used, see here, what you have got? Power is your inventory. Inventory is used for the benefits of the employees. Anyhow, we will not get into that. In exchange of power equivalent to 20,000 units. So I will give you 20,000 units, you give me 1 lakh talk times. And normally A Limited will charge 50 paise per minute and B Limited charges 2.5 per minute. Ah, beautiful numbers. How the revenue should be measured in this area? At what value telecommunication should recognize the measure the revenue, because they have given you the number. And now why I told you the previous thing important, these theories you may have to write here in the examination. In the examination they may say analyze and account. In that case you have to write the theory that look, it should not be within the same line of business, it should be at the fair value of the asset received, blah 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 story. In the given case I am going to do this. Okay, this is my calculations. Understood? Yes. Now just tell me one thing, what is the transaction price for 1 lakh minute talk time sale to telecommunication company, and what is the transaction price for 20,000 units to a power gen? Same. So what do you think in exam? Exam, no, they may make something like this. Why? Because you have to value the transaction price equal to the fair value of the consideration received, and they will test you in the examination, have you understood it, or will you get confused with Ind AS 16 there, or Ind AS 16 comes in your mind and say fair value of the asset given up. No, I am telling you, if you don't have that clarity, this all things will start cooking in your mind in the examination hall. That's what they test. And every single question I am showing you, is it not 50-50? Everywhere. Not here, from lease to you talk any question, everywhere they give 50-50. One time only in the examination they give 50-50. Only one time. It is surprise to me. And okay, every time they will change it. Testing whether have you understood what that percentages mean. Okay. Yes. Yeah, correct. Both revenue, no. Nothing. You have to say telecommunication, that means somebody got a better negotiation. Here, no loss, no gain to anyone. In that case, the telecommunications commercial department is very smart. No, nothing, no off-market transaction, it is a pure negotiation. This is what happened. You need not talk anything there. So 115, see, this is the theory you have to write. Transaction price is the amount. What is transaction price? It is a fixed or variable. However, when non-cash consideration is there, you have to measure at a fair value of the asset received. If it is not available, then you have to recognize it as standalone price. And in the given case, there are both different lines of business. That's why we will recognize the revenue. Otherwise, if it was a power transmission between one transmission company to another transmission company, we will not pass revenue recognition entry. Why? Because the agreement is to barter, no. I will give you power now, you will give me power back. Sorry? I will record it. That's it. Standard cannot tell you everything. For this, what accounting entry I should pass, that goes to the framework for preparation of accounting. I have to record it somewhere, whatever I have given to you. When this shop owner takes the shoe, will he not keep on record of how much shoes he has taken? They will keep it, but they will not pass revenue entry. They didn't say that I have made a sales today. Why? Because he knows that at the end of the day, he will not get a cash for the sales. He will get a replacement of the whatever he has given. So the revenue to be recognized is 50-50. Otherwise, it is going to change. Follow, no? Yes, a small aspects. Once this is done, then we'll go for a big level questions where you will apply all the, see, again, every question we are looking one aspect, and that is very interesting application part, no? You really understand how it works. Yes, next is consideration. The last part is the consideration payable to the customer. Sometimes entity may purchase goods and service from the customer and adjust the money due from the customer in its revenue. Or a seller only buying from the customer. Have you seen such instance? You are a seller, you sold, and you buy back from something from the customer. Not non-cash consideration. You buy the customer's product. Seller will buy customer's product. Sorry? Yeah, what is that? No, is that damaged goods their product? Is the damaged goods their product? No, is there, see, if you give something, if the damage happens and my contract says I'm going to get it back, then it becomes a variable consideration. I have to estimate how much damage may happen. It is not consideration payable to the customer. Again, I said, if you remember variable consideration, I said variable consideration and consideration payable to customers are very similar. Like for example, discount. You can say no, discount is consideration payable to the customer. Okay, it's payable, no. That's what, it's something like that. But it is not exactly. To give you a specific example, what a consideration payable to the customer, have you gone to Super Bazaar there? In that Super Bazaar, have you seen inside the Super Bazaar, on the wall and all, they have put, okay, American Express. Next to that, there are bags. When American Express bags are hanged there for sale, they have put one advertisement of American Express board there. Paytm here. Have you seen that? That's an advertisement, no? Instead of PhonePe can come and say, no, PhonePe here. Have you seen that hanging, Paytm here? The meaning is, Paytm here means you can make the payment to this, what is that called, More or Super Bazaar using Paytm. Now, why this guy who is that Super Bazaar should permit Paytm to hang their hangings? He say, give me money, no? Because PhonePe is already standing outside my door, he wants to hang his hangings there. Why I should permit inside my premises to hang your thing? So this is called a slotting fees. There is something like a slotting fees. Like Patanjali has sold something to Super Bazaar. But the moment you enter Super Bazaar, at the front door, there is one rack. In that rack, nicely Patanjali store items are kept. So that the moment you enter, it attracts your attention. Marketing tactics. Now, to keep your products in Super Bazaar, at the entrance, Patanjali has to pay some money to Super Bazaar. Because that slotting is the product of that Super Bazaar. First of all, Patanjali themselves have sold to Super Bazaar, and to keep their product just in front of the entrance, they pay some nominal amount of money to Super Bazaar again. Because if Patanjali doesn't pay, Hindustan Unilever is going to pay that money. Understood? Yes. See, are you clear about this? Payable to the customer, because in this case, Patanjali sells to the Super Bazaar. This is Patanjali sells to Super Bazaar goods and services, say worth 1 crore, and Super Bazaar will charge 5 lakhs or say 50,000, whatever it is, to place their products just at the entrance. You must have seen that, no? And simply somebody will not, everything is going to cost. Now, when the Super Bazaar will pay, will they pay 1 crore or 95 lakhs? 95,000, 99 lakh 50,000. They will deduct and pay, no? Now what is the transaction price? See, Patanjali sales is 1 crore. Say for simplicity's sake, we will take 1 lakh. Super Bazaar will sell its slotting fees to 1 lakh. Whom we are applying 115? We are applying 115 to them, because he is paying consideration to the customer. 1 lakh, who is paying whom? Patanjali will pay him, no, and he will pay cash of 1 crore to him for the sales. This is slotting fees. Now, from the perspective of 115 for Patanjali, what is transaction price? Okay, first thing, is it fixed? Is there? Yes, how much? 1 crore. Is there a variable consideration? No variable consideration. Fixed, no. 1 crore you have to pay. I have given that much of material. Is there a significant financing component? No. Is there any non-cash consideration? No. Is there any consideration payable to the customer? Yes. Why? Because when he pays you, he will not pay you 1 crore, he will pay you 99 lakhs. Now, my only question to you is transaction price 99 lakhs or is the transaction price 1 crore? Forget, we will not apply 115 to him. When we apply, we will see, we will, Patanjali it is 1 crore. What are others' opinion? Or Patanjali it is 99 lakhs. Because when he pays me, he will pay me net 199 lakhs. Because, yeah. Okay, I'll ask you one more example. Patanjali has sold some goods to, who is this, our Super Bazaar. Have you seen in front of the Super Bazaar, next to the road, when you go, there is one big hoarding. So Patanjali has put one advert, this is worth 1 crore rupees. Now, in front of the Super Bazaar, not inside Super Bazaar, in front of the Super Bazaar, one big hoarding has been put, and that hoarding is an advertisement on Patanjali, for which they charge 1 lakh. Now the transaction price is 1 crore or transaction price is 99 lakhs. Question is clear? Is it different or is it same to previous question? See, now you understand the theory. So first of all, I will give you a problem now. You have got a confusion? Yes. Definitely two different contracts, or it may be part of this contract also, who knows? Or there are two different contracts but prices are interconnected, who knows? That's why now let us understand, see the beauty of the standard. It says that if such payments are not made for distinct goods or services, it should be reduced from the transaction price. Like when Patanjali paid 1 lakh for slotting fee, is that slotting fee a distinct goods or services or not a distinct goods? It is not a distinct goods. Why? Because who can use this slotting fees, slot? Only the seller can use it. Like, have you seen here, Paytm here, when you go to make the payment, he says that Paytm is not there. Then you'll fire him, no? If Paytm is not there, why you hanged here? You see that American Tourister, one poster they have put inside this. You want to buy one American Tourister bag, you go there and ask them, sir, where is him? He says, American Tourister bag is not there. If you want, you take. Then you say, why this boarding is put? So that means this slotting fees, advertisement fees, which you pay inside, it is not distinct. So both are one, because this cannot be separated from the main sale transaction. If you sell this, then only this is available. If you don't sell this, this is not available. In such case, it is 99. Perfect. That means if you have paid for distinct goods and services, you account it like other purchases. But there is one catch. If the payment exceeds the fair value, you have to reduce the excess amount from the transaction price. I'll explain now. See the beauty of this. See, now I'll go to the second part of the question. You put one board outside there. Can I go and put one board there, 36 chamber? Anybody can. Is it necessary that I have to supply some material to Super Bazaar so that outside I can put one hoarding? No. That means this advertisement is a distinct. When it is distinct, how can you connect it to the sales transaction? That's why your sales should be 1 crore only. Then whatever you pay for 1 lakh, this is called advertisement cost and it will get debited to P&L account. But there is one catch. See, this advertisement slot is, if I go and ask, no, they will charge me 2 lakhs. Then immediately I'll shout, Arey Baba, when Patanjali is asking, you are giving it 1 lakh, why you found me 2 lakh? Then they will not tell me, but inside source will tell me, they are charging 1 lakh. Why? Because in this, that extra 1 lakh, no, they are giving me discount here. Actually, they are selling 1 lakh, 1 crore, 1 crore, 1 lakh. But 1 crore, 1 lakh worth of goods, they are selling at 1 crore, and that difference they are adjusting in this advertisement expenses. Understood? Or I may increase, Patanjali may end up paying 5 lakh for something worth 1 lakh. and that extra 4 lakh they will adjust in their sales there. No, that's why they say that, look, if you have purchased distinct goods and if any payments you have made to the customer who is in excess of the fair value of that holding was 1 lakh. If Patanjali pays more than 1 lakh to that outside holding, which is the distinct goods, your advertisement expense is 1 lakh only. That 4 lakh you adjust with the transaction price, because definitely your transaction price must have been inflated also. Because here you pay Patanjali more money, definitely you also must have sold at a higher price. Adjust it. There is no insight, You cannot inflate your P&L account with some idea, because you are not a related party, but you are known party, no? So one good understanding between Patanjali and say I'm taking names only for example sake. Good understanding. You say, I will increase my sale, okay, and whatever extra, no, you increase your sale. So both P&L is showing very glorious picture there. Are they related parties? No, they are a customer and supplier. Previously what you would have done? Nothing. Accounting standard. Now I will tighten. I will not permit it. That's why I will take it through the rule. Is the consideration payable to the customer for distinct goods? If answer is no, straight away reduction from the transaction price, because it is directly connected with the transaction. If it is no, it is distinct. Then check, is it exceeding fair value? If yes, reduce that excess from the transaction price. If no, then you account it as an advertisement expense or whatever on earth is the separate transaction. Now you understood? Okay, now we will apply. Okay, this is the last thing. Then we can go to the next step. Okay, question number 25. An entity manufacture consumer goods, enter into a 1-year contract to sell the goods to a customer that is a large global chain of retail stores. You are a manufacturer, say Patanjali, some Walmart, they have agreed to sell. The customer commits to buy at least 15 crore products during the year. The contract also requires entity to make a non-refundable payment of 1.5 crore to the customer. Alright. The supplier has to pay, or Patanjali has to pay to Walmart now, 1.5 crore. What for? At the inception of the contract. And this will compensate customer for charges it needs to make the shelf to accommodate the entity's product. Like you have gone to drink Coca-Cola, or you want to buy one ideal ice or Coca-Cola. Have you seen the fridge there? Coca-Cola fridge. Who is paying whom? Did that shop owner purchase this? No. Coca-Cola himself gave that. Like this, if that's why the shop owner says, why I should keep your thing? That is an advertisement, no? That's why this Walmart says, pay me 1.5 crore so that I will prepare a beautiful shelf and your products I will place in such a manner that customer will come and take your shelf, your products only. Now in the first month, okay, now question comes, who is the owner of the shelf? Entity does not obtain any right over the customer's shelf. That means it is not PP for me. Otherwise I should have accounted as a PP if it is a separate transaction. So I don't have any right, so that is an expense. But how? It should be expensed over the terms of the contract. Determine my transaction price and pass the necessary journal entry. Pass necessary entries from my understanding, for your understanding. In the first month, entity transfers goods worth of 1.25 crores. In the new study material, the sentence related to 1.25 crore first month billing is not given, but the solution it is considered, okay. So in the solution they said, in the first month 1.25 crore is transferred. Question not there, solution they have there. So I have included in the question. Now tell me students, when you transfer 1.25 worth of goods in the first month, you as a seller, what accounting entry you will pass? Should you pass an accounting entry for revenue? Who? Entity or that Walmart? From whose perspective you are analyzing this? Entity's perspective. Okay, first thing, is there a contract? Yes. Performance obligation? How many? How many performance obligations are there? Distinct or series of distinct? Series of distinct. But it is one. Why? Because it is substantially same. What you transfer every time. This time you transfer rice, next time you transfer tractor. No, that is not series of distinct, because you transfer something differently. Then you say they have got two performance obligations. Here since every month you transfer the same and you have got the same pattern of transfer over a period of time, it is a series of distinct goods but with a single performance obligation. Now, what is the transaction price? Is it a fixed consideration? Yes. Is there a variable consideration? No. Is there a significant financing component? No. You transfer, you get the money. Is there any consideration payable to the non-cash consideration? No. Followed? No. If it comes one aspect, one accounting. Ultimately, you have to calculate one transaction price. They may give you. So, you have to calculate the transaction price with all these adjustments. Last one. Is there any consideration payable to the customer? Yes. How much? 1.5. Will you deduct this 1.5 crore from 1.25? No. Because this contract is meant for total 15 crore worth of products. So, you are going to buy again and again during the entire year. So, this 1.5 what I paid is for, see, if he says, I will worth 2 crore, give me 1.5 crore to construct a shelf. You say, supplier will say, get lost, no? He will buy 2 crore it seems, and he will construct one shelf. I will not pay this 1.5. I paid you 1.5 because you are going to buy 15 crores from me. Now, did I get any distinct goods? How do you know? No. But did you get the control over it? No. That's why you didn't get any distinct goods. If it had manufactured and given to you, you would have passed an accounting entry for PP. You would not have adjusted it from the transaction price, because you paid it for a separate transaction. No. But it is not distinct. Why? Because you cannot buy the shelf in the customer's premises. But that does not mean you cannot buy. You can buy. If the contract permits, if they understanding they have. But if at all tomorrow you get the right over that shelf, it is your PP located in the customer location. Tomorrow you tell me, when this Coca-Cola fridge was given to that retailer, who is the owner of that? Retailer. Okay, then that means can he replace what is that called, a Coca-Cola, and put Pepsi there day after tomorrow? What happens? Immediately Coca-Cola salesman will come and take the fridge back. So the condition is, I will keep my asset in your premises provided you keep my product in that product. So the owner of the fridge is Coca-Cola only, Baba. Because if the owner becomes customer, he has got every right to keep whatever he wants. No, tomorrow he can keep vegetable also. That's what, it's a separate transaction. It's a separate transaction. If you get right over this 1.5 crore worth whatever you paid, then what you paid is for a distinct goods and service. So if it is a distinct goods and service, you account it like any other purchases. Don't adjust with the transaction price. What you paid to the customer is for a distinct goods. Then you account that payment as a separate transaction. Don't adjust with the transaction price. Is for a shelf. Did you get that shelf? No. You got only a right to keep your material there. That's what, without selling, if you don't sell 15 crore, is this shelf of any use to you? Or can you tell, sir, I will not sell, I will sell my right to somebody else? Like, see, for example, Patanjali is telling Walmart, look, I will not sell my product to you, but in your Walmart there is one shelf, no? You have permitted me to keep my material. I will not keep, but this right I will give to some other third party. Will Walmart agree? Why? Then I will give this to one Maruti car. Maruti car have kept their demo cars in that Walmart's thing. Do we have the right? Exactly. Do we have the right? Question is silent. And they said entity do not obtain control of any rights. That means in that shelf, I have to keep only my material. Whatever I sell here, 15 crores. If you don't sell, this shelf will be vacant. Yes, exactly. What do you mean by any of the shelf means? I'll explain you. There is one shelf here. In this shelf, if Patanjali sells to Walmart, Patanjali items will be kept. Can Patanjali tell Walmart, look, I will not use this because I have not sold you anything. Ulta, I will tell one Ketan fan to keep their demo Ketan fan there, one table fan there in that shelf. Will Walmart agree? No. Why? Because, okay, by looking at the Ketan fan, somebody will come to Walmart and say, sir, give me one Ketan fan. Well, what Walmart will say? Walmart will say, we don't sell Ketan fan. Customer immediate, then why that is kept in that showcase there? That's why Walmart will never permit it. They will keep only those items in the shelf which is sold inside, because it's a demo shelf. And entity will not get any right to transfer that right to keep to somebody else. That means what 1.5 they paid, they didn't get any rights, special rights there. That's what, that is not distinct from what you sell, no. If you have to use this 1.5 worth of asset, you have to sell to the customer. If you don't sell, that shelf is of worthless. You cannot transfer that to some third party. With the customer, with the retailer, the complete control is with the retailer. That's why since you didn't get any rights, first condition do not apply here. Oh, sorry, you didn't get any condition, you apply the first condition here. This condition becomes applicable. Not distinct. The payment made 1.5 is not for distinct goods and service. If at all, for that shelf, if I would have got a control, the payment for that shelf would be for a distinct goods. In that case, I will account it like other purchases. What purchases is it? PP purchases. I will not adjust my transaction price. Since I have got paid for a shelf on which I don't get a control, I have to account it, adjust it from this 1.25. How much? For 15 crore, I paid 1.5 crore. For 1.25 crore, how much is I need to adjust? Like this, on every sale, my accounting, when the sale happens, you don't pass the entry called customer account debit to sales 1.25. Okay, that you should tell what entry you should come. That gives me one understanding that you have understood or not. Let us read the solution. In the contract includes the consideration payable to the customer. Agree? Something the seller paid to the customer. Is it for distinct or not distinct? Not distinct, because you didn't get any rights. So, however, payment is not towards any distinct goods because you didn't get any rights. And this payment is useless unless you sell. So consequently, entity determines that the 1.5 should be reduced from the transaction price. Thus, how much every time you need to reduce? Because you did one time only 15 crore you didn't sell. You are selling on a staggered basis. Why? Because it is a performance over, it is a series of distinct goods over a period of time. That's why you transfer 10% every time, which is nothing but 1.5 divided by 15. And in the first month, when entity transfers 1.25, you will recognize 1.125 crores as your revenue. Can you tell me the journal entries here? This is the theory. In examination, this is what you need to write. But let me, please tell me the journal entry so that I am very happy to know your understanding. To revenue? No, impossible. Revenue will come down, no, by that amount. If this condition was not there, what you might have done, okay, that we will see. If this standard was not there, what entries you would have passed, we will see later. As per the standard, what journal entries you are going to pass? Sorry? Customer account debit to? First you paid 1.5, no? Or you paid later? If I go back to the question, at the inception of the contract only you paid 1.5, no? What entry you pass? Contract asset account debit to bank. Okay? Why? Because it is not your PP, but it should be adjusted with the transaction price. So first on this payment, you pass the entry, okay, you can call it contract asset or I can call it slotting fees account debit to bank, but I will not take the slotting fees to my P&L account. I will take to the balance sheet. because this contract is going to go for 1 year or 2 years, because I don't know 15 crores how many years it's going to take for that many, because one contract is for 15 crores. Understood? And then in the first month when I sold 1.25 worth of goods, what accounting entry I'll pass? I sold 1.25 goods, no? What entry I'll pass? First thing, customer account debit to revenue. Okay, how much I will debit to the customer? I will debit to the customer 1.25 only, because that much he purchased from me, he has to pay me. Now, how much I will recognize revenue? Not 1.25. I will recognize 1.125, because that slotting fees what I paid here, I will amortize it over next 15 crores worth of purchases. So, one portion of it I will credit to, instead of taking to P&L account as an expense, I will net it off from the revenue. If these provisions were not there, what would have been the journal entry? When you paid 1.5, what would you have done? Slotting fees, customer means, is it payable to you? Do you get a contractual right to receive cash? Fees to bank. Because you cannot say customer, because he will not pay you cash. No. That is sunk money, gone. Whether you keep your material, you don't keep the material, that is a sunk cost. Now what you do with this slotting fees is a nominal account. What you will do? P&L account straight away. See, gone. Our what is that called? Cut-off concept gone here. This cost is meant for full 1 year or 5 year. You transfer to the P&L account. And when the customer buys from you, what entry you pass? Customer to sales. That means your sales is overstated eventually every year. And that cost what you incurred to make the sales to happen, that is charged to P&L account. Now, you will not take it to P&L account. Rather, you reduce your sale from time to time. Why? Because what you paid is not for distinct. It is pertaining to this sale transaction only. If it was paid outside the campus or something, or he would have given you that right of PP, you would have passed one entry, PPE account debit to bank, and every year customer account debit to revenue, 1.25. Never will you get, can you tell the customer, sir, I don't want, give me my plotting. Now that's what, if the customer sells to you that rights, then you would have passed an entry PPE, no? Or ROU. Lease. Sorry? Net of 1. That's why you are adjusting the transaction price. This is what theory we were discussing here. You have to adjust it the transaction price. So here also no incentive for you to play. Previously you were playing, no. You means not you, Papa, those sellers, to inflate their financial statement. 50 to 60% fraud happens in revenue recognition. You see how it's good. Now we will discuss special cases. You see, no, none of the instances have been left now. Literally nothing. You can't do anything there. Simply whatever you account, that's why we as an auditor, we need to have that precise knowledge about this standard. Are you clear? Yes. You see this RTP and MTP question, very important, 4 mark it may come. Entity K sells electric razor to retailer for 50 per unit. A rebate coupon is included in the razor blade, no? There is one rebate coupon. You see, no, that Sprite you drink. Inside that cover or somewhere one coupon is there. In the package, that can be redeemed by the customer for 10 rupees per unit. Is this customer consideration payable to the customer? Yes, in the form of discounts. It's like a discount only, you know. Did you get anything distinct? That's what you can say, call it cashback. And for whatever 10 rupees you are paying cashback, did you get anything from the customer back? No, that means it is not distinct. And why it happened? Because of the sale happened. Can they come without buying 50 rupees? Can they come and say, sir, 10 rupees you give me? No, because this sale and this sale are interconnected. You didn't get anything distinct back from the customer. That's what I'm telling you. These coupons, you can treat it like a variable consideration, discount, or you can treat it like a consideration to the customer. It's the it's not distinct because you didn't get anything, no. Now entity estimate that 20 to 25% of the sales will be redeemed. Will everybody go and pay the money? No, somebody will open it and tear it and throw. Now based on the experience with the similar programs, you remember this, I know, the 7 comes with the 10 rupees coupon for your Airtel recharge. Have you recharged? No, because our recharge go with full, that because we have got used to, no, unlimited 1.25 2 GB and all. But there are some people who don't do that unlimited recharge. For them 10 rupees also they feel very happy. So everybody will not come with the cashback. That's why they say that since it becomes a variable consideration, because you may have to pay something, they estimated 20 to 25% may come back and ask for money. Now K concluded that the transaction price should include 25% is the best assumption. That means right now the day I sell, I cannot recognize revenue for full 100% because 25% of the people may come and ask my money. As this amount for which is highly probable that a significant reversal constraint will not occur. How should you determine the transaction price? What is my transaction price here? When you sell 50 rupees, say for example, I sold something for 50. What accounting entry you pass? I will tell you the accounting entry, bank to revenue. Tell me the amount. Huh? How much? See, understand, I will have received bank 50. When I said to revenue, if this coupon was not there, what I would have told? Simple lie. But what did you do? You bundled something, you included. So I cannot say 50 because in this 50, if that customer comes back to me, I have to pay 10. So are you 100% sure that he is going to come back? No. What is, how much you think, how many customers will come? 25%. That means 10 rupees into 25% expected value method. 2.5 I may end up paying, so I will recognize 47.5. What is that? It's per unit. Then multiply with the number of units there. This is what we did in that TV sale and all. I understood. You took direct, no. Sales, sorry, no. It should not be done like this. But sir, some theory you need to write. Yes, here it will be redeemed for cash. Consideration is payable to the customer. Nothing distinct comes back to you. So it should be adjusted with the transaction price. And you have to estimate it because at the each reporting date. So 50 rupees is the selling price. 2.5 is the variable consideration, which is amount payable to the customer. Estimated amount 47.5. And it should be accounted as a contract liability. So journal entry is very clear to you. This question can be a probable question in the exam. If 100% people will come, then 40 rupees will account. And 10 rupees is the contract liability. 10 rupees is the payment amount. Max to max, how much you pay? 10, no. That's what your accounting entry will bank account debit, revenue 40, to contract liability 10 if 100% are going to come. And this is what we have done. Let me see one thing. Clear, no, students? Yeah, that's what. Who is accounting here? Company itself is accounting, no? When the sale happens, the revenue recognition entry is passed by the company here. Clear?